Okay, so our next keynote speaker of the morning is someone that I first connected with back in 2012. He was a Lend Academy reader all the way back then. We shared a common passion for the space, and we started communicating quite regularly. Then towards the end of 2012, I stopped hearing from Ron, and he just went real quiet all of a sudden until mid-January, when he called me up and said, "Oh yeah, by the way, tomorrow I'm going to go work at Prosper, and we're going to have a whole new management team." And since that day, Ron and Aaron Vermouth and Steve Vermouth have transformed Prosper into what was a company in trouble that may not have seen it through that year to one of the industry powerhouses. And I don't think there's anybody in this room who does more for this industry, not just for Prosper, but for the industry as a whole, than Ron Suba. So, ladies and gentlemen, please join me in welcoming the president of Prosper, Mr. Ron Suba. Yeah. I love you, man. Thanks for joining.
Thank you very much. What an honor and a pleasure it is to be here today. I have had a blast this past year traveling literally around the world and across this country so many times with so many people in this room and watching on the LendIt channel right now. We've been trying to explain what we are and what we aren't, and what we're doing and why, and really reiterating the so many benefits to the borrowers and to the investors. And we've also really enjoyed welcoming so many people from around the world, from Latin America, South America, Asia, Africa, Europe, to America, to help explain our observations and share our experiences. It's been a lot of fun. We have so many fans, but we also have some people here who are looking to take advantage of us, that are here for a short-term trade, and they won't be part of this industry. And we're going to address lots of points about where this industry is and where we are, what we call ourselves, and where we're going. There literally isn't a place on this map that doesn't have an online marketplace for credit, or a marketplace lending solution, or one that's about to come. Whether it's the Middle East or Russia, it's there, or it's coming. And it's coming in consumer, in business, in student loans, in mortgages, in franchise finance, and insurance. I saw lots of things on my travels. I rarely saw cash. I rarely saw a credit card. I didn't see one physical CD, and I didn't see one Blockbuster store where people went somewhere to go get a movie. And that's because, despite the naysayers, all of those things went online. And those naysayers who don't think what we're doing, moving finance, moving borrowing, moving lending, moving investing online, are going to be stuck with lots of stores and lots of CDs. Because it is now unanimous, because of the efforts of everybody here and all the action around the world, borrowing and lending are going online, and it's going to be different. I've literally crisscrossed back and forth, and I've really enjoyed some of the stops. The cultures, the food, clearly the languages, and a lot of us are going back on the road this summer to continue to spread our story and tell the benefits. So today I'd like to do a few things. I'd like to take a look back, and let's look at what the skeptics said. Some were right, and some were very wrong. How did we do? Let's review the big, hairy, audacious goals you all told me last year, and I put up at last year's LendIt to see how we did in 1 year. And I want to quickly track the industry conversation, because boy, has it changed since we left each other a year ago in New York. And then I want to take a look forward and talk about what's more clear now. I asked many of you 30 days ago, tell me the one thing that's more clear to you now, and I'm going to share that and some things for me. And I want to share with you, what are we? What is Prosper? How do we define ourselves? And kind of what do we think about in this new era? And then share with you 4 thoughts for the time ahead. So a lot of skeptics have been telling us certain things. One very smart skeptic said to me, hey, when a marketplace lender sells a bunch of loans and the buyer isn't aligned with the marketplace, if the buyer of those loans is going to buy those loans and leverage them, rate them, and securitize them every single quarter without alignment with the industry, and just sell those bonds into the marketplace, this skeptic said to me, that won't be good for you, for the industry. And we learned that lesson. When we don't have alignment with our investors, when groups sell our loans into the market no matter what, if the market's not ready, it's not good. And we learned that at Prosper this year, and I think as an industry, we need to listen to that very smart skeptic. Another very smart skeptic said to me, hey, a rating agency just rated a loan batch and a securitization on a marketplace. And the rating agency has a lower expected loss ratio than the other rating agencies and the marketplace itself. And that smart skeptic said to me, this is going to be a problem. Because when the loans perform better, the rating agency is not going to say we made a mistake. They're going to threaten to downgrade the bond to cover themselves. And that skeptic was right too. And the message here is that we must control our story. That we as the platforms, we as the investors, have to make sure we're articulating our version of the truth and not let other people have that opportunity to do to us what others are trying to do in the industry. What did some of the other skeptics say? One of the skeptics said, the Fed is going to raise rates one day, and you all aren't going to be able to handle it. Well, the Fed did raise rates, and we did handle it. We did perform as platforms. We did iterate as a marketplace should. Leverage providers raised rates, and they raised rates because they have their own net interest margin calculation and a risk-weighted asset calculation. So we saw banks raise their rates, the cost of capital, and some banks said we have enough consumer or business credit. Could we survive and iterate and operate and grow and thrive when this happens, that one skeptic said. One skeptic said, I don't think you marketplaces will ever raise rates. It will just be a race to the bottom. Well, we did raise rates. We raised them in the fourth quarter and again in the first quarter. You know which investor I called as soon as we raised rates to say, hey, it's time to buy. One skeptic said, what are you going to do when the bond markets get volatile? How will you compare and contrast? Well, we all know about volatilities. It hit treasuries, it hit corporates, and it even hit emerging markets. And the stock markets around the world, in the developing world, in the US and Asia, also got volatile. And people said, how are you going to perform as online marketplaces for credit? Well, all this happened in the last few months. So how did we do? If you go to the Orchard platform and look at the index of consumer, we did pretty well, month over month, 3 month, and for the year, on a relative and absolute basis. Those skeptics were wrong, those who said we wouldn't make it through all of those changes in the global economy. How did we do versus these other asset classes? Equities, fixed income, international, high yield. We did pretty well. Those skeptics didn't think we could put up those numbers. And how did the funds do that invest in the platforms? I went in the Orchard Manager database. I looked at a couple unlevered funds and levered ones. They sure look pretty good to me, especially compared to other type of fixed income related investments. This is from the industry. This is not from me. This is a slide many of you know from last year. These are our industry's big, hairy, audacious goals from a year ago that the crowd contributed. So how did we do in 12 months since we were all together in New York? Universal standards, we've done really, really well. Reps and warranties, leverage, some great successful securitizations. And we've seen the ecosystem help us create universal standards. Again, Orchard, PeerIQ, DV01 and Manja, helping us do what we do and do it in a similar, understandable, data with visualization way. AA, we did it. In fact, one platform is going to get a AAA rating on their securitizations. We're making tremendous progress with the rating agencies and these big, big money investors understanding the quality and the higher ratings that we have earned and we deserve. And a year ago, when we did securitizations, there was only one rating agency per securitization. And now we see 2 and 3 securitizations, rating agencies on single securitizations. Have we seen a top 10 bank do a deep, deep top-to-bottom partnership with an online lender? Not yet. We're making progress, and I love to see the news, but we're Not quite there yet. Mainstream adoption, yes, we've improved the education, awareness, and understanding, but we're not quite there yet. Not everybody around the country and around the world knows what a marketplace lender is. And capital treatment, we have a long way to go here. We're making progress with the banks and how they leverage and treat the loans that they purchase from us. I was so sure a year ago that we would have a couple listed 40 Act funds here in the US, and they're not here yet. There are 4 in registration, and we are cheering them on as an industry because we want more access and distribution. We want more doors and windows where people and institutions can go to their Schwab or Fidelity or JP Morgan account, buy a stock, a CUSIP, a listed fund, and own loans from us. It exists in London. It needs to exist here. I thought it was going to be second quarter. I'm kind of told it might be third quarter. But I think this is something a year from now we'll have the checked box. And $20 billion in a year, they're doing it in China, and we haven't quite done it here. But we're on our way with quality growth and consistent growth. So this is something interesting. I thought about what were we all talking about last year. There were literally 60 press releases the morning of LendIt last year. We were talking about something called growth. And everyone was saying, what's your number? What's your number? How much did you do this month, this week, this quarter? Originations per month. Equity capital funding. There was this race to call ourselves unicorns. And then in the third quarter, the conversation changed. It was really the first time that marketplace lenders got serious about working with banks. And banks got super serious about working with us. You saw us get SOC 1s, audits, all these kind of things the banks needed so we could meet their regulatory requirements, we could meet their vendor requirements, business continuity, and all those other bank things on top of the great credit we do that already meets the bank and regulators. We saw a major shift in conversation to cost per acquisition and CAC and conversion, and you saw some platforms go from single product to multiple products. Some went student loan, mortgage, consumer, you get the idea. Some went business to consumer, some went consumer to business. You saw lots of product expansion in the hopes for doing more than just the one product. And then in the fourth quarter, we saw this concept of profitability being important for the platforms, for our industry, as we thought more about, perhaps some of us, going public or doing another round. We definitely saw the decline in the public names in our industry. And that definitely had an effect on the private ones. And I put it up on the board last year that there would be failures around the world of marketplace lenders, and we started to see those here in the fourth quarter of last year. It's normal, it's natural, it's supposed to happen. And it will happen again to some platforms that don't get to this thing called equilibrium, which we'll talk about in a minute. We saw something as an industry this last quarter for the first time that I hadn't seen in 2.5 years. And that is this concept of funding pressure. For those of you here last year, you'll remember the picture in the bottom right-hand corner of the 3-legged stool. That's us. The right leg is our product. It's the borrower. And the left leg is the liability side. It's the capital. It's the balance sheet. It's the person. It's the bank. And for the first time in a long time, we're starting to see the left leg need a Band-Aid. It's a little short, and we have to recreate ourselves as an industry to make sure we bring on new capital, smarter capital, more permanent capital, more long-term capital. We raised rates. We saw spreads widen in securitizations, making that not quite the right way for people to reset and reestablish their balance sheets. And boy, oh boy, did we see press skepticism for the first time like we've never seen it before. And we as an industry have been going back to the press and trying to really help them understand the benefits and the why and all the good things we're doing in addition to the other stuff they're writing. I think we're going to see some really important new things this quarter and next quarter and throughout this year. And that, again, are these new structures that make investing easier. The days of groups wanting to come and just buy whole loans, it'll still happen, but it's not going to be the same. We're going to need other doors and windows, other arrangements with other fiduciaries and trusted advisors to pensions, endowments, and foundations to help us distribute the great product that we do. We're going to see many trade associations in addition to the one you saw with Prosper and Funding Circle and Lending Club. And we need a secondary market We need price discovery. We need liquidity. We must make this happen. And we're working very closely as an industry with Orchard and others, and DV01 and PeerIQ, to create that liquidity, to create that change of price. These are very important things for us to focus on. So I texted about 100 people, and I said, what's the one thing that's more clear to you today than it was a year ago? And a couple people said, we're balder and we're more gray. But they also said this, that we do have more education, awareness, and understanding. That underwriting is still the most important thing we do, more important than borrower acquisition, and even more important than capital markets. Failures are clearly going to happen, and so are mergers. While there might be 300 marketplace lenders here and 3,000 in China, they're not all going to make it. I don't know which one, but certain ones aren't going to make it, either failure or merger. Again, it's natural. It's supposed to happen. Europe and China are so much bigger, are what people said, and that marketplace lending is no longer an alternative investment. It's no longer alternative fixed income. It is this established fixed income asset class. So what do I know for sure that I didn't know quite so clearly a year ago? And that's that what we do, it's not just about origination growth. It's about building a business that lasts. As Sequoia says, it's about building a 100-year franchise. And what I know, to do that, we must be commercial. We must be institutional and have the quality that the biggest investors and the biggest partners want to work with us. Meet the bank requirements and communicate proactively with every single regulator that Peter and others put up on the chart. This concept of permanent capital is critical. It's not just a joke. We must figure it out as an industry. And we have to come up with these product structures and make sure that we're in everybody's fixed income allocation. When you see 60% equities and 40% fixed income, we should be a slice of that 40% fixed income. And that focus on equilibrium, getting our left leg, our liability leg, back in balance with the size of the product leg and what's under the hood, the middle leg. So I want to leave you with 4 things today, some thoughts that I think are critical for all of us, whether you're an investor in a platform, in the debt or equity, whether you're running a marketplace, whether you're here in the US or somewhere else in the world, in our industry. And that first point is that open systems thrive and that closed systems don't work. I'm 52 years old. I remember the biosphere. Half of you in the room don't know what that bottom picture is. But these people thought they would create this closed society where nobody new would come in. No water, no air, no food. It doesn't work. And you see these 2 icons of companies that were closed. They didn't have an app store. They didn't have an ecosystem. They weren't transparent. And my point here is that we must stay transparent and we must stay open in order to thrive, like these companies. The second point is, what are we? What is Prosper? I can tell you one thing. We're not something I heard the other day called Finternet. That's not what we're doing here. I won't tell you who said that either. Are we fin? Are we tech? Are we financial technology? Are we engineering experiments? What is this? I think this is what we are. I think we're finance companies that are using technology in a different way to offer products and services beyond loans to help people achieve their financial well-being. So for us to be just online marketplaces for credit, where we do 36-month and 60-month loans, and we email people and direct mail them, that's not who we are. That's not what fintech is. The components of what we are growth companies like the panel talked about before. And we have awesome data analytics, not just on the data we get, but what do we do with it once we get it? It's about our marketing expertise, our ability to find borrowers that fit our credit models at the right price at the right time, with this awesome underwriting. It's the secret sauce, the most valuable part of the middle leg of the 3-legged stool. And capital markets, we've learned the need to have onshore and offshore, retail, institutional, and listed products. And it's about the people that we're attracting to this industry. To me, this is who we are. This is the third point, and I think this is one that you can all relate to, because we have all shifted in our everyday lives, especially this last year, how we interact with each other, with our children, with our parents, with our information about ourselves. And we've done it in our personal lives with those 4 companies and in our personal and business lives with marketplaces. And I think you're going to see a change in the way we all interact as marketplace lenders and online marketplaces for credit. For Prosper, we're trying to shift the way people interact with us, with our online marketplace. We don't just want to do 3-year and 5-year loans. We want people to look at us and communicate with us every day. And so we have something called Prosper Daily. And what Prosper Daily does, it connects to you, to your Apple ID, to your tax ID number, to your bank account, to your credit cards, to your checking account. It helps you optimize your financial position. It sees where you have cash and you have a very high credit card or some inefficiency. It helps you with your credit score. It helps you with fraud. It tells you if you went to the gas station and 2 charges hit you at the same time. And this is where we think the future is going for Prosper. You saw what we did with Home Advisor, how we now have more than just debt consolidation, more than just Prosper Healthcare lending, but big advancements into other types of consumers engaging with us not once a month, but 5 or 6 times a week, where we're doing more than lending. And we can now start to see if you're doing something you shouldn't, we can help you improve your financial life. Right swipe, borrow money, line of credit or loan, and pay off that loan you shouldn't have with a credit card or something else. To me, this is what differentiates us in our industry to truly being fintech. It's this relationship of doing more than just loans and hoping we get a second one when it's paid off. So we put this up here last year. We talked about the cycle of innovation. How do you get from the left of a novelty all the way over to the right? And this is the process of innovation, and so much has to change, and the hardest part is on the right. And I said last year that we were here as an industry, as online marketplaces. We were somewhere between this interesting new niche and this great idea. And we had a lot to do as an industry. I thought we were going to be way to the right this year, but I actually think we're here. And I think this is our challenge as a group, and in the US and around the world. Look at the BlackBerry. Awesome device. I never thought I wouldn't have it. But changes had to happen. Hardware, software, ecosystem, app store, screens. You get the idea. These are the hard things to move to the right. And that's what we need to do as an industry, are some very hard things you've heard about from people this morning, and you'll hear about from people tomorrow. We need to perform through the cycle. There's no doubt we have performed well, but whatever happens, interest rate, economy, GDP, oil, we need to perform on a gross and net basis through the cycle. We need to be in every single fixed income asset class. And we do this through product expansion and liquidity and secondary markets and listed vehicles. All those things have to come together for us to make that big leap to the next circle. And we have to be these trusted global brands, which is why we need to be transparent and have the people and the capital and the articulation so that this next generation will trust us and use us for more than just term loans. And again, I want to harp on this last one. This is so critical to us that we have the App Store, that we have the ecosystem, and that we have this ability to communicate across all of our different platforms, because they're different. The products are different, the duration's different, the risk is different, but the ecosystem will help us do repricing and do all the things that will require us to get all the way to the right. So for me, everybody knows this is personal. I've never been more excited to be here, to be part of what we're doing. I am literally looking forward to heading back to Asia. I literally just got back from India, telling this story. What's happening here is something for the ages. It's amazing what's happened from the first LendIt to here. So thank you very much to all the pioneers, the people who've put your hearts and your wallets into this business, and I look forward to getting all the way to the right with everybody. Thank you.
So we have time for a couple of questions. If you want to go up to the microphone. Anyone? Everyone's hungry? Well, I got a question before. So I'm curious about what the conversations you have now, how are they different than they were a year ago? When you're talking about conversations with investors, how are they different?
What's interesting on the conversations with investors, everybody knows platforms have fractional pools and whole loan pools where you can be active or passive, and some securitizations and some other ways to get to us. And what these new big investors are looking for are new paths, new trust certificates, new single packages of loans from us where it's easier. And there is some type of liquidity and some type of QSIP. And that's back to the doors and windows. I think the way people and institutions and pensions, endowments, and foundations will be buying from us and banks will look very different. And we're iterating and creating as an industry to meet those investors' needs.
Mm-hmm. Okay, I think we have a question right here.
Thank you so much for your presentation. Really, really interesting. Can you talk a little bit more about the evolution of the underwriting process? Like, what did you know starting, and how did that thinking and the processes evolve through time?
Absolutely. So when Aaron and Steve and I got to Prosper in January of 2013, there was this guy, Josh Tondres, who had built this Prosper credit model called PMI3, the Prosper Marketplace Inc. version 3. And he and his team wanted resources and money and engineering and product talent to build PMI4, and then 5, and then 6. And in each iteration, we're working with the receiver operator curve to get more efficient and up to the left. And that's by bringing in new data sources and new decisioning engines and new ways we can work with the data and learn from the data with machine learning, and then adding more people from banks and rating agencies and credit card. It's really a combination of all that data and then new ways to learn from it. So as we go now and build PMI7, we can do bigger loans or smaller loans or more point of sale loans. But it's all an iteration, and if you haven't seen the receiver operator curve, you'll see where we're all going up to the left. It's so much better than it was in credit and underwriting and servicing and collections. And it's way better than using just the FICO score.
Thank you.
Anyone else? Okay. Well, Joy, can you go out to the microphone?
Hi, thanks for the great presentation. I had a question. You've been traveling all around the world. Is this sort of Prosper going global now, or is it just learning? What's the international expansion plan?
Yep. So what's happening is there's this insatiable desire for yield and short duration credit. It's happening in Australia and Korea and Japan and Israel and everywhere, Canada, you name it. And so we're being asked to go to all these places to articulate the credit and the duration and the yield and the gross and the net, because lots of money is coming to the US marketplaces from all these other countries that also have the need for short duration credit. So for Prosper at this moment, we are working with investors from around the world, but on the borrower side, they're still here in the United States.
Thank you.
Okay, do we have one more question? Okay.
Hi, it was a really nice presentation. This is my first conference, so this might be, this question is from a novice. Going back to your earlier quote about Finternet, I guess the question is, what's the real competitive advantage over the long term, and what's the barrier to entry from big banks as well as from a small lender who might have a niche advantage, like for example, Prosper Pittsburgh, which just does small, online lending in Pittsburgh. What prevents the market becoming a fragmented landscape of small lenders who are niche players?
So I used to get this question a lot, and I used to say that what we do is actually really hard, and we've made it look just a little too easy. And we've seen lots of groups come in and say, we're going to do it too. We're going to be me too. And they've realized, like yoga and bridge and other games, it's much harder to actually do it than to read about it or watch it. And so what we're seeing is some of these new entrants aren't able to balance the stool and to get equilibrium between finding borrowers at the right time, at the right price that meet the credit model, and finding investors at the same time who want that same credit. And then that middle leg of the stool is technology, accounting, marketing, management, credit, and keeping a balance. You've seen some fly-by-nights come in and do a ton of business, and then they're gone. Or you've seen them come in and the credit model doesn't work through the cycle. So I think this is much harder than it looks, and I would encourage you to come meet with the marketplaces that have been around to share some of those experiences so you don't repeat some of the same mistakes that have already happened in the industry.
Thank you.
Okay, I think it's time for lunch, everybody. Give Ron Suber a big hand. Thank you. Thanks, buddy.